As of Saturday, April 25, 2026, the market is currently closed for the weekend. Opendoor Technologies, trading under the ticker OPEN, finished its last active session on Friday, April 24, at a price of $5.51 per share. This represents a substantial intraday climb of 5.65% from the previous close, a move that caught many off guard given the broader sector volatility we have seen throughout the spring. While the surface-level story is one of a quick percentage gain, the reality is far more complex and involves a massive tug-of-war between retail momentum and institutional skepticism. The immediate detail that most people are missing is the sudden explosion in trading volume. Opendoor saw over 35 million shares change hands in a single session, which is a significant spike compared to its recent averages. This wasn't just random noise. It followed an 8-day winning streak where the stock surged over 26% in cumulative value. Most investors are looking at this and assuming the housing market has finally bottomed out, but the reality is that this price action is being driven by a high-stakes short covering event and a strategic leadership pivot that is only just beginning to show up in the data. While the common narrative suggests Opendoor is a play on interest rate cuts, the deeper truth is that the company is fundamentally rebuilding itself into an asset-light marketplace, moving away from the heavy balance sheet risks that nearly destroyed it in 2025. If you look at the general sentiment, the expectation is that Opendoor is still just a house flipper that lives and dies by the 30-year fixed mortgage rate. Investors often view it as a high beta proxy for the real estate market. When rates look like they might dip, people pile into the stock. When they tick up, they flee. However, I want to challenge that perspective. The current reality is that Opendoor has transitioned to what they call Opendoor 2.0. They are no longer just trying to buy every house in sight. Instead, they have tightened their spreads and focused on a partnership model with platforms like Zillow. This means their success is becoming less about the direction of home prices and more about the volume of transactions they can facilitate without actually holding the inventory. It is a shift from being a real estate speculator to becoming a high-tech transaction utility. This is why we are seeing names like Nvidia stock or Apple stock get all the glory for AI, while Opendoor is quietly using similar machine learning models to price homes with surgical precision to avoid the massive write-downs that plagued them in years past. The recent trading activity shows that big money is starting to pay attention again. We saw fresh capital injections from specialized investment groups recently, which provided a floor for the price when it was languishing near the $4 mark. This institutional activity is a massive contrast to the very weak rating many traditional analysts still carry on the stock. You have a situation where the backward-looking financial metrics look terrible because of the losses incurred during the 2024-25 housing freeze, but the forward-looking indicators, like the financial open house video series they are using to replace traditional earnings calls, suggest a management team that is confident in their new unit economics. They are targeting positive adjusted net income by late 2026, and the market is currently trying to decide if that is a realistic goal or a pipe dream. To put this in perspective for the individual investor, if you are using something like the Robinhood app or the Fidelity mobile app to track your portfolio, you've likely seen Opendoor popping up on the top gainers list frequently over the last 2 weeks. This creates a psychological trap. The expectation is that the momentum will continue forever, but the reality is that the stock is approaching a massive resistance level near $6. Institutional sellers often use these retail-driven rallies to exit their positions, which is why we saw some profit-taking in the after-hours session on Friday, with the price slipping slightly to $5.46. When you consider the broader landscape of online investing and investment help, many people are looking for the next big recovery play. They look at the Interactive Brokers platform or their SoFi active investing account and see Opendoor as a cheap way to get exposure to a housing rebound. But the smart money is looking at the spreads, the difference between what Opendoor buys a house for and what they sell it for. In the first quarter of 2026, these spreads have stabilized significantly. They aren't trying to make a killing on the appreciation of the home. They are trying to make a consistent fee on the convenience they provide to the seller. This is the same type of toll booth model that makes companies like Visa or MasterCard so successful, although with much higher operational complexity. The macroeconomic pressures are still very much in play. We are seeing a steady reset in the U.S. housing market where mortgage rates have settled around 6%. This is a new normal that Opendoor has finally learned to operate within. During the early days of their growth, they were spoiled by 3% rates, which made every mistake look like a genius move because home prices only went up. Now they have to be precise. Their AI-driven inspections and automated title services are designed to cut down the time a home sits on their books. The faster they turn the inventory, the less they are exposed to interest rate swings.
This is the core of the expectation versus reality tension. The public expects them to be a victim of the macro environment, while the reality is they are building a moat around operational speed. If you are an investor who prefers a more hands-off approach through things like Schwab Intelligent Portfolios or a SoFi robo-advisor, you might not see a single ticker play like Opendoor in your top holdings because of its volatility. It is a high-risk, high-reward individual brokerage play. For those using the Fidelity trading platform to build a custom portfolio, Opendoor often sits alongside other aggressive growth names. But you have to ask yourself, is the current 26% rally based on fundamentals, or is it just a relief rally because the world didn't end? The answer likely lies in the upcoming Q1 earnings report on May 7. This will be the moment of truth. If they can show that their October 2025 cohort of homes is selling at a profit, it validates the entire Opendoor 2.0 strategy. If the margins are still thin or negative, the stock could easily give back all of its recent gains. Let's look at the business model for a moment. Opendoor operates three main streams: direct iBuying, their exclusives marketplace, and their partnership ecosystem. The marketplace side is the most interesting because it is asset light. They connect a buyer and a seller, take a fee, and never own the home. This is the direction the company has to go if it wants to be valued like a tech company rather than a real estate company. When you look at Tesla stock or Nvidia stock, they are valued on their future potential and their software-like margins. Opendoor is trying to bridge that gap. They want the market to stop looking at them as a graveyard of suburban houses and start looking at them as the Amazon of real estate. Now, I want to hear from you. Comment below how many shares of Opendoor you currently hold, or if you prefer to play the real estate sector through more diversified options like Fidelity ETFs or mutual funds. Are you a believer in the iBuying model, or do you think the traditional brokerage system is here to stay? Looking at the future outlook, there are two distinct scenarios. In the bullish scenario, Opendoor continues to scale its partnership with Zillow, effectively becoming the back-end fulfillment engine for the entire internet's real estate searches. This would drastically lower their customer acquisition costs, which has historically been one of their biggest expenses. If they can get to a point where 40% of their transactions are through the asset-light marketplace, their path to profitability becomes a certainty rather than a gamble. This would likely drive the stock back toward double digits, a level it hasn't seen in quite some time. On the flip side, the bearish reality is that they are still a company that loses money every quarter. Their net income is still in the negative, and they are burning through cash, even if the burn rate has slowed. If the Fed decides to hike rates again, or if the economy enters a sharp recession, the housing market will freeze. In a frozen market, nobody wants to use an instant offer service because the uncertainty is too high. Opendoor would be stuck with inventory they can't move, and the very weak rating that analysts have assigned to them would prove correct. This is why you see such a divide on investing sites. Half the people think it's a moonshot, and the other half think it's a falling knife. The institutional activity we've seen on the Interactive Brokers platform recently suggests that some hedge funds are starting to place bets on the soft landing of the housing market. They are looking at the 8.41% recent jumps and the 5.6% intraday rose as signs of a breakout. If the stock can hold the $5.5 level and turn it into support, the next technical target is $6.2. However, if it falls back below $5, the momentum is likely dead, and we could see a return to the $4.3 range. This is the reality of trading a stock with this much baggage. You aren't just trading a company, you're trading the collective fear and greed of everyone who remembers the housing crash of 2008 and the iBuying collapse of 2022. In summary, Opendoor Technologies is currently a battlefield. The expectation is that it is a fragile entity at the mercy of the Federal Reserve. The reality is that it has undergone a massive internal restructuring, focusing on AI-driven efficiency and asset-light transaction volume. Friday's closing price of $5.51 reflects a growing optimism that the Opendoor 2.0 strategy is working. The company has moved from the brink of delisting in 2025 to a $5.2 billion market cap today, driven by an 8-day winning streak and a fundamental shift in how they acquire and sell homes. As we approach the May 7th earnings date, the tension between the market's narrative and the company's financial reality will reach a breaking point. Investors using Robinhood, SoFi, or Fidelity are watching closely to see if the company can finally prove its path to profitability. The contrary take here is that the macro environment doesn't need to be perfect for Opendoor to succeed. It just needs to be predictable. If they have truly mastered the art of the zero-touch transaction, they could redefine the real estate sector. But for now, the stock remains a high-stakes play, where the reality must finally meet the high expectations set by this recent rally. Stay grounded, watch the volume, and pay attention to those unit economics. They are the only thing that will matter in the long run. Disclaimer. This video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, unshare with your friends, bell, subscribe for more updates.